Welcome back to another stock analysis, where I look at some key metrics to calculate the fair value and my buy price for the stock. Today I'm going to analyze one of the biggest producers of consumer goods, which of course is Unilever. Last year we generated a revenue of 50.7 billion euros, and then we have a market capitalization of 120 billion euros. As said before, Unilever sells consumer goods, such as ice cream, tea, or cleaning agents. To be more precise, the revenue can be divided into three main segments, or divisions as it's called in the annual report. These are beauty and personal care with 42%, food and refreshment with 38%, and home care with 21%. In total, Unilever owns over 400 different brands, which is a lot. You might actually know some of them, such as Lipton, Magnum, Ben & Jerry's, or Dove. These are some of the biggest. The revenue can also be divided geographically. The largest quantity comes collectively from Asia, Africa, Middle East, Turkey, Russia, Ukraine, and Belarus, with just below half. Next comes Europe with 22%, North America with 20%, and last but not least, Latin America with 12%. Now I'm going to determine how much I should pay for the stock. To determine what the fair value of the stock could be, I'll start with looking at the dividend yield in a historical chart. I choose the dividend yield because a consistent dividend policy for me is the best indicator for a stable company. Additionally, a steady dividend payout helps to stabilize my portfolio. To smooth out the curve, I take the 5 years moving average of the dividend yield. The simple approach is now that the stock seems overvalued when it's under the moving average and undervalued when it's over it. The average of the last 5 years is 3.24%, and I would like to define this as the historical dividend yield. Since the historical dividend yield is the fundament from a fair value and buy price calculation, this value shouldn't be too volatile. I can measure the volatility by calculating the relative standard deviation, which in this case is 8.7%. To the historical yield, I add a margin of safety of 25%, which I will adjust upwards or downwards depending on the matrix of the company. My first criteria is the stability of the dividend measured with the relative standard deviation. For a value of 8.7%, no adjustment of the margin of safety is made. My next criteria is the dividend growth. The dividend has increased from 88 cents in 2011 to €1.71 in the year 2021. The company pays a dividend since 1962, and in the last 5 years the average dividend growth was 6.22%. The 5-year dividend growth is in the yellow section of my rating scale, which means no further adjustment to the margin of safety. I'll find out if this dividend growth is healthy for the company by looking at the payout ratio. I always look at the payout ratio in respect to the free cash flow, which is the cash flow the company has available after they've paid all necessary expenses. The free cash flow from Unilever increased from 5.22 billion euros in 2018 to 7.59 billion euros in the last 12 months. The cash dividend were respectively 4.1 billion euros and 4.37 billion euros. The average payout ratio is therefore 64%. The value is inside of the yellow area again, which of course means no further adjustment. Next, I'll take a look at the debt situation. The company has a debt of 26.8 billion euros and has 6.3 billion euros in cash. When the cash gets subtracted from the debt, and this value then gets divided by the EBIT, the debt to equity ratio is found, which for Unilever is 202%. This means it will take around 2 years to pay off the debt if the whole EBIT were used for this, Once again, the value is in the yellow section. Last, I'll take a closer look at how the business is going. The revenue has almost not changed. In 2018, it was 50.98 billion euros, and in the last 12 months, it was 50.72. This gives an average growth of minus 0.2%. In the same period of time, the EBIT increased from 9.46 billion euros to 10.11 billion euros, which gives an average growth of 2.3%. The margin is found by dividing the EBIT with the revenue, which in 2018 gives 18.56%, and in the last 12 months increased to almost 20%. The margin therefore increases with 2.45% in average each year. An EBIT growth of 2.3% is in the yellow section, which gives no further adjustment. The margin growth is in the green section, therefore I'll subtract 5% from the margin of safety. Since nearly every rating is in the yellow section, I only subtract 5% for the margin growth. The new margin of safety is therefore 20%. This leads to a desired dividend yield of 3.89%, and by a current dividend of €1.71, I should therefore don't pay more than €44 for the stock. By ignoring the margin of safety, the fair price of the stock is determined to be €53. These values can also be shown in the graphs for the historical dividend yield. To do this, I just add the line in the graph for the historical yield. As seen in the graph, the yield line is just under the marginal safety line, and therefore I consider the stock as overpriced. Finally, I consider the stock at its fair value when the price is €53. I will buy the stock at €44, and the stock price is currently at €45. If you did like the stock analysis, please consider to give the video a like and subscribe to my channel for weekly content.